Hi, and welcome to Real Talk with Rabbit and Rudder. I'm Billy Rabbit of Hometown Real Estate.
And I'm Ron Rudder, and this is where we discuss education topics in the world of real estate.
And in today's segment, we're talking about what do you need to do to buy a house and start the process. And we have invited our special guest, Mr. David Keys of Waterstone Mortgage, along with us.
Welcome back, David.
Yeah.
Absolutely. So Dave, you know, one of the questions that we get all the time from first-time home buyers, even people that have bought houses in the past, where do we start? What does that process look like? So from a lender's, perspective, what is the first step?
Mm-hmm. Typically the first step, it sounds redundant, but we get the application in.
Sure.
So that application can be done a number of ways. We can do it over the phone. We can do it face-to-face. I know COVID kind of puts a little hamper on that. Or we can do it right from their email account. I'll send a link. The application is a short questionnaire. Generally takes 5 to 10 minutes, really simplified down now. And once I get that application, then we can go forward with trying to retrieve some of the documents and everything I'll need for the actual pre-approval.
Gotcha. So Dave, one of the things that we hear all the time too is, pre-qualification, pre-approval. We know in this market a pre-approval is, a little bit stronger, but what is really the difference?
So the pre-qualification is going to be based off most of the time the numbers that are submitted on the application. Once we get some basic documentation in there, we can start to move closer to that pre-approval. In our industry, typically the pre-approval is valid when we have an automated underwriting approval. So we have a series of systems, automated underwriting tools that allow us to say, hey, based off all of the documentation, everything's accurate in the application, and automated underwriting approval comes back and says, hey, they are approved. It will give us an approve, a denial, and things like that. So once we have that automated underwriting approval, that's when it moves into pre-approval status.
Gotcha. Now, when they get this pre-approval, is that something that's fixed? What are some of the things that our clients should not do to screw up that pre-approval?
That's actually a great question. I work with that all the time. So what you don't want to do after you get through the initial pre-approval process, any credit-based accounts, we want to kind of keep those where they're at. So we don't want to charge money. We don't want to buy furniture. We don't want to finance anything. We've had situations where people will finance furniture, they'll finance cars. All of those things have a negative factor to credit, and it's going to have a negative factor to your debt-to-income ratio, because that's a new payment now going out, where we have so many things we calculate into that debt-to-income ratio. So once you make those changes, it can really, it can actually kill a loan in the process.
What part of the process do you revisit the pre-approval? And one of the terms that we hear in the industry is clear to close.
Yeah. So it's something, at least with myself, I like to address right up front when the application starts. Because between application and what actually is showing on the credit reports, it can change the process. So I like to be upfront and say, hey, have you opened any new debts that aren't appearing, that are fresh? I always try to advise my people, my buyers, that going through this, we don't want to have any unnecessary charges. We don't want to have any unnecessary financing go through. We want to keep this picture as pretty as it is now. We don't want to change the picture in any way. And that allows a much smoother process because we don't have variables changing. So at every step of the process, I always like to reiterate, we make sure we're being cost effective with our money. We're not opening any new accounts.
Okay.
So Dave, in this market, we're seeing houses fly off the market very quickly. Buyers are really having to rush. Buyers and agents are having to rush out there, see houses as soon as they hit or whatnot. One of the things that I really stress to my clients or whatever, and you really help out a lot, is making sure they have all the documentation and know what documentation there's going to be, because one of the things that we're seeing a lot of is how quickly can we get to closing, right? I know a lot of lenders are 45 days, 60 days out. But how important is it, having all the documentation up front to get you to that closing?
It's vital. It's vital in the sense of making a strong offer. If you have the documents there, you can be much more exact on exactly what they can afford. One of the practices I like to take too is I like to see the house that they're actually making an offer on, and I work up independent numbers for every home, because there's certain variables. There's HOA, there's taxes that fluctuate up and down. And taxes can take you out of a pre-qualification rather quickly. So if you were to say a blanket statement, you qualify for $300,000. Well, that was a house we were looking at that had $200 a month taxes on it. Where now you're looking at a home that has $350 a month taxes on it.
Right.
Changes your monthly payment, and it can put you outside of the debt-to-income ratio requirements for the loan you're going into.
Sure.
Right.
And I know that there's lots of different programs out there that can help, all kinds of buyers in different situations and different circumstances. What is one of the things that you're stressing to maybe like a first-time home buyer, one of the things that they should really be considering when they're thinking about buying a particular house?
So I want them to consider, is this going to be a home that they're going to be in for a long period of time? Is this their one and only, or is this a home that is maybe a starter home? Because that's going to affect how we go ahead and approach a situation. Then, if they're going to be in the home a short period of time and they think that they're going to be moving on, then there's some things we can maneuver around to make it much more financially responsible for them. But if it's something that they're going to be in for a long period of time, a lot of times we can look for the long haul of things, different programs and things like that. There are certain programs where factors are your mortgages, insurance, and things like that fall off after a certain period of time. So there's a lot of variables that go into it, but every situation is so unique with buyers. Everybody's got their intentions and what they want to gain out of the purchase of the home. So you really want to take a personal view when you're talking to your buyers. You want to do what's best for them. A lot of times people will say, hey, what's my max I qualify for? It's kind of a loaded question. What I try to do is I want to know what your budget is monthly, because I want to keep you inside of a comfortable budget. So if you tell me $1,500 and it gets you a house at this sales price, you know what, that's where we need to look, and that's where obviously I get the numbers right and I defer to their real estate professional. So.
Yeah, one of the things that you brought up that made me think about was some of my clients, they may get confused as to what the actual numbers are. So they'll go online and they'll look at, okay, what's my monthly mortgage? And it'll say $900 a month, for example. But that doesn't take into account the HOA and the taxes and that sort of thing. Can you explain why it's not just a small, that's the mortgage, it's the other things that are added on?
Absolutely. So your mortgage consists of principal, interest, taxes, and insurance. We know that all of those variables in that can fluctuate in the market. So what's really important, that's where I go back to doing pre-qualifications per home. I always like to do it per home before the offer goes in, because that way it gives you a chance to discuss with the buyers that said, hey, I know your budget's $1,600. This house puts you at $1,650. You still qualify, but is this something you're comfortable with doing? We don't want any surprises in the process. We don't want to get to the settlement table and all of a sudden, why did my payment go up $60, $70?
Right.
We want to put everything out there. We want to pull the correct tax bills for the years per home. And we want to make sure when they get to the table, they know their payment. They've known it from the beginning since the offer was accepted, since we were ratified.
So Dave, you bring up a lot of really solid points. One thing that Ron and I do when we're out working with buyers is talking about investment, right? Because it is truly one of the largest, acquisitions or purchases that somebody or a family is going to make in their whole lives. So that's so important. And, and one of the other points that you brought up was real critical, is that, every house is different. Every situation is different. And, even from county to county, city to city, it's so critical to make sure that we're doing that. And one of the things that Ron and I do is we ask, yourself, our mortgage, our lender professional, to send out a fee sheet too. So we know what closing costs are going to be. What are the expenses? What does that monthly payment look like? And really ensuring that everybody is solid and everybody's asked all the right questions and we've answered all the questions so that they feel extremely confident that we can provide the best offer to win that house of their dreams. Well, Dave, we truly appreciate you coming out today.
Yes,
Thank you.
It's been an absolute pleasure, and hopefully we've been able to answer some of your questions, or at least help guide you to the path of buying your dream home. And please visit our website at www.exploremdhomes.com to find out anything and everything related to real estate here in the Southern Maryland market. We hope to see you next time. Thank you.